We can see from this hourly chart how it's been straightforward to be long with the short-term demand in play. Short-term demand, red over orange, correct? Red over orange, short-term demand. So you're able to find those bottom line areas where the short-term demand is now tradable. Now, obviously, when it came into the top edge here, you could now look at that and say, I get it. So there was short-term supply here, orange over red, top edge, orange over red, top edge, good sell. And then red started to overtake the orange into these dips. It's short-term demand, and it drove the price $76 up to $79. At the $79, I seen the C vol coming in from the CME was bullish. So I was feeling I don't think there's going to be any buyers above 79. So that gives me a view of the options side of the market. And we talked about that this morning. We had a little look at C vol, and we recognized the oil price, WTI. We could recognize the change in the C vol was strongly positive. And because the change is strongly positive, I'm more inclined to lean on the short sale on oil during that period. I'm more inclined to lean on that. So that's giving me a C vol, a volatility perspective of oil, which we may touch on this afternoon in classroom later. But let's go back to the structure. You can see that by sticking with the overall macro structure of this trade here, that the long trade is the right trade to be on. It's entirely blue, almost exclusively blue for the entire period. And therefore, leaning with the structure on the demand line made a lot of sense. But there's a problem. If I zoom out of this chart into this peak, we then come across the second chart. And this is the second chart here. Take a look at the macro view of oil. And all of a sudden, what we see from the macro view is if we look at this supply line coming in, it's actually divergent above $78 a barrel now, isn't it? It's entirely divergent above $78 a barrel. So when we see that the supply line is entirely divergent above 78, the zoomed in focus, of course, shows the demand showing up, which is exactly right. But the zoomed out focus shows us that there is net supply in this oil market at the moment. Net supply, not demand. You might say, but if there's net supply, why is there nobody selling the top edge? Because the micro world is telling everybody to just hold fire for the time being, correct? Why would you sell oil at 77s and 78s when you know you're going to be able to sell it at 79s? That would just be rubbish business practice. So the macro is incredibly important, but it's only becoming important when it starts tying up with the short-term bid and offer spreads starting to show into play. So when we think about that as a storyline, we start to recognize this overall macro view and the micro view tying together to give us the probability that there's now a short sale. Now, if you go back to the first chart again, you may have recognized on this very last candle here that the red line drops and the orange line rallies at $79 plus. So in other words, the short term actually started to give us a very easy storyline of short selling value into the closing bell. And the closing bell, of course, coming in just here. So we're now looking at that and saying, right, that's it. We now have our top in place at $79 plus. You then are able to check, for example, your C vol if you're using the C vol from the CME, and you can see that it's positive, and you think to yourself, well, that's even better news. C vol's positive. I like the story. I like the idea of getting a short macro, short micro trade. And obviously what I've now got here is the conclusion. It sits inside the macro supply background as shown on the second chart. We're telling you what to be aware of. Each time we put in the micro supply in line, I will work hard on the offer. This was at 10:40 last night. 10.40 last night. I'm going to work hard on the offer each time we put that supply in place. And obviously, when we look at the oil charts today, I've been able to sell once off the 79. We took it all the way down, and I sold twice off the 79s, and we've taken it all the way back down again. Yes, there was buying opportunities here when the sellers got too committed. So we had already talked about that in classroom this morning, and obviously the outcome from that was very good. But obviously when the buying starts to appear again at the top lines, we're back short again. We're back short and we're making a lot of monies. Okay, it was only $400 on this occasion. Still $400 in our account rather than somebody else's. So we've got to make sure we take into consideration the macro and the micro view of the marketplace. We'll obviously do this just after lunchtime. We'll go back over today's London session where we talk about the undergraduate trades that you could have had in the London session from the S&P perspective. And yes, they made money. Yes, you would have been successful. Yes, you would have been again able to point to the undergrad trades and say, my goodness, do I need anything other than the undergrad trades? Well, let's take a look at them this afternoon before today's cash open so that we can understand just how well the undergrads got done on these. But before we do that, let's take a look at the other big macro trades. The euro-pound trade from yesterday was the only trade in town as far as I was concerned based on the 10 o'clock New York cut. Based on the 10 o'clock New York cut, we can see that we had a very sizable sale coming in euro-pound. The price was 86.40s when we took the screenshot, which means that all of these 84.75s and 86s are below the current price. That means that there's going to be net selling coming in euro-pounds. At the same time, the pound dollar is going to have net buying coming in against the dollar to the tune of 1.4 billion pounds. 1.4 yards of buying, more than the normal. That's going to be bullish pounds. So if that's bullish pounds against the dollar and it's bullish pounds against the euro, that's the two biggest crosses that sterling has. And sterling's bullish against both of them. So because it's easier to trade against the euro for the from a safety point of view, because the dollar could go off and running, I think this is a no-brainer trade here. An absolute no-brainer trade. To the tune of 4 yards. 4 yards. So if you've got about 4 yards of extra selling coming in, that's not a small trade. That's a pretty good sized trade, guys. So when we know that there's about 4 yards of selling coming in and we come down to that target price of 86s, that's a 50 pip move with a drawdown of nothing. Absolutely sensational. Taking that overall global view of the marketplace, the buying pressure and the selling pressure that's going to start coming in as the hedge unwinds, when there's no demand and there's no need to have the hedge. The selling pressure that's going to come in on the price as this price starts to drop simply is just perfection. Absolute perfection. And the other trade we had, of course, on the short sell was using the bond storyline that we talked about this morning. You'll see from bonds last night, the storyline came from the auction, the 2-year auction. Now, some people look at the 2-year auction and say, but it was quite a good auction. Yeah, but the devil was in the detail of that 42,000 contract short on the 2-year treasuries. 42,000 contracts. Just calculate what your margin would be on that 42,000 short contract. Quite a sizable position, isn't it? The reason why we knew it was short was because once the block trade came in, the price sold off, but it was also something else, something I asked the question in the room that everybody seems to have forgotten about again, and that is the location of the block trades is very important to us. We've covered this in classroom before, so I was surprised that it wasn't a simple, easy answer for everybody. If we get a block trade in this location here in terms of the technicals, it's almost guaranteed to be a sell trade because it's the only price a market maker will be willing to do the transaction. If somebody contacted me on the desk and said to me they want to sell 42,000 two-year treasuries, and they contacted me when the price is up here, I'd tell them to go and get stuffed. What the hell would I want to be buying 42,000 two-year contracts at that price for? I can't even rotate the price and make money. So that's going to get a get stuffed response, right? So when the block trade comes in towards the bottom of the prior bracket, I know that it's almost guaranteed to be a short sell. It's very similar to block trades in the dark pools space. If you've got a sizable block trade in the dark pool space and it's at the top of a bracket, it's almost definitely going to be a buy order. If you've got a sizable dark pool trade and it's at the bottom of the bracket trade, it's almost guaranteed to be a sell order. Does that make sense to everybody? Just put yourself on the other side of that trade. You'll understand why the only trade you would ever be willing to accept is the guy that's selling to you at the bottom edge here. Because it's not an invisible conversation like dark pools are. This conversation takes place before this deal's transacted as a block trade. It's not some anonymous buyer and seller. With a block trade happening, what happens very simply is that you get a conversation with another bank. So a bank phones you up and says, would you be interested? Would you be interested in buying 42,000 two-year treasuries? Now, obviously, if the idea is that we've got the two-year auction coming up, the idea is I can get rid of that trade very, very easily in the two-year auction, but I've got to get the same price. I've got to get a slightly better price. I've got to get a slight profit on the deal. So what this guy promises me is that they will not drive the price yet. Now, that doesn't mean somebody else won't drive the price. But the guy promises me they will not drive the price yet if I take the other side of the deal. And what that means is that I know that they will give me a bit of support on this play. So if the price, obviously, I pull away my liquidity, we'll both back it up at these lower prices if the selling does come in. So I'm going to pull away my liquidity so that somebody doesn't just jump on board the sell. And then if I can get some more sells at lower prices, I then rotate it up and then I exit my trade in here. Exit my trade in here. On 42,000 contracts, if I exit my trade for a couple of ticks, I maybe make, a full point, I maybe make $30 on that trade. Think about that for a second, guys. Imagine I make a bond single point on 42,000 contracts. That's not a bad little profit for a market-making position, is it? To make $1.2 million by taking the price up by one single tick, is it? One single tick. But what it does have is it has an impact on the fact that I now know that this has a very high probability of being a short sell. And I now know that it has a very high probability of being a measured move. Because obviously for a guy to sell at this price, they're not expecting the price to go to here. They're now going to be looking at that and saying that that's going to be net the effect. And I would imagine that they'll be looking to try and get the deal done, assuming it was a net short position and not an exit position. But they generally wouldn't do it as a block trade if it was an exit. We can obviously understand that that's going to be their target price into that box there if they've got net short here. Well, if that's the case, that's exactly what happened here. Take a look. If I look at what went on in the background here, the block trade comes into play here. Where is it located? At the bottom of the bracket. So I know at the bottom of the bracket here that position there, that net short, that trade there, that 42,000 contract, 2-year treasury short is a short play. And I know that based on that storyline that they have a target price based on their entry. They've got a target price of round about this price area here. So I've already got a view of what I'm going to be doing on this bond. I'm going to be looking to sell off of the 2-year auction in the evening session. And we got short into the bonds. We managed to take a blue line spread here, which was crazy, by the way. We then resold the bond back into the trade here, resold the bond. So we're short gold and short bonds at this stage. And we absolutely tanked the price into our target price area. And since our target price has been achieved, you can see quite clearly that all we've done is bag and tag our monies. All we've now done is achieve the goal, the objective that we thought we were going to achieve. Another macro storyline ending in a conclusion price, which was exactly the measure that we thought we were going to get, exactly the measure that we gave you guys in the room this morning. I think we said 24s in the room this morning was the big target price. 24s is exactly the price that traded. You couldn't make it up, could you? You literally couldn't make it up. We would love to have seen 20s because that would have been exactly $1,000 from the sell trade here. But realistically, the high price here was 24s. So as soon as you knew that the high price was 24s, you knew that the low price was probably going to be 24, couldn't you? You could probably etch that one into your diary and just wait for that 24 to print, knowing that that sell trade there, auction sell, was going to hit 24s and bounce. So you're not hanging around for the exit, are you? You're not hanging around. You're taking your profits on the deal. And that was crazy. Not just crazy, because it also tied in very simply with the curve, didn't it? You know, if we look at how the curve developed, if we look at the 2s 5s curve, is there anybody that doesn't think that curve is steepening during that balance? I mean, come on. Take a look. That balance area, look at the curve shape there. And tell me that that wasn't part of maybe that 2-year trade to get net short. It's part of that curve, isn't it? It's part of that curve trade, perhaps. Because if you look at what bonds were doing, they never went anywhere. And yet the curve steepened significantly. Well, if that was part of that big short on bonds, it's part of this big long steepener on the 2s 5s. And obviously, as part of that 2s 5s, you can see the trade absolutely scalped through. Because they might have sold the 2-year 42,000 contracts. What did you think they did? What did you think they did in the 2-year auction? They were obviously buying the underlying product, weren't they? So a lot of people say, you know, I don't quite understand, because if they sold the future, surely they would sell, if they're selling the 2, they would expect this curve to drop. Except, of course, that there was a 2-year treasury auction coming in here for $42 billion. So they were actually getting involved in the curve trade here using some of that block trade and some of the underlying physical. So you can almost guarantee it was one of the direct dealers that did that trade, almost 100% certain. I mean, that kind of size is almost going to be a direct dealer anyway. And do you think they made a fortune on buying the curve for that steepener? Massive fortune, right? 42,000 contracts gives you a fair idea of how much money they made on that trade. Put it this way, the curve went from a price at that stage, 19.5, and it traded a high price of 29 for 10 points. 10 points, guys. So let's assume it was a pure position of 42,000. They made 10 points on that spread. That's $300. That means that that trade made that bank $12.6 million. $12.6 million in the overnight session. It's not a bad takeaway, is it? It's not a bad little profit for a auction trade. $12.6 million, assuming they did the target price that we've just been talking about. We're saying it's not exactly earth-shattering stuff. 12.6 million, of course, might not be earth-shattering stuff in the world of, several $100 billion of profits here or there chucked around. But that profit comes from these $12 million, bearing in mind this was one trade in one product in the overnight session. One trade in one product in the overnight session. It's crazy how easy it is to recognize the setup. It's crazy to recognize the price. And it's crazy to then take advantage of the footprint of the big trades. So when we look at this, what have we just talked about? We've talked about the big short on oil based on the CME CVOL. We've talked about the big short on the euro pound based on the New York cut. And we've now talked about the big short on the bond based on the underlying block trades and the 2-year auction and the 2s5s curve storyline. The big story traded to perfection in every example. The oil short tweeted last night. The euro pound trade not tweeted, but obviously it's the trade you would have noticed if you had done the classroom, of course, and this is a storyline. And then, of course, it leaves us with a bond. The storyline of bonds at exactly the same time. When we see the storylines, it's just about drawing lines. When we draw the lines across the charts and we recognize the shapes of patterns that form, and we start looking at like-for-like areas, and we start considering the overall slopes, the overall highs, the overall lows, the stories. All of these trades had a macro component to them. The sell on bonds based on block volumes, which we tweeted last night, of course. The sell on bonds was tweeted. The sell on oil was tweeted. The reason why was tweeted. Doesn't get any better than that, does it? So you pick up on these storylines, you pick up on the themes, you pick up on the drivers, and they don't stay the same drivers tomorrow, and that's why people forget about them, because today there might not be any block trades on 2-year treasury. So you might be looking for them because you're excited, but they don't exist. They don't exist anymore. They don't often happen. I spotted a bet last night that I told Kim about. I was getting a handicap of 1.5 on the Phillies. How did that bet turn out? A handicap of plus 1.5 on the Phillies. Now, that's not going to happen very often, is it? That's not going to happen very often, that you get a handicap of 1.5. So when I saw that, I thought that seems to be way out of line with the overall algorithm. Agreed? And did a handicap of 1.5 win, Kim? But if you look for the same handicap today, you might not see anything. If you look for the same handicap storyline today, you might get absolutely nothing from it as a story, mightn't you? You might get nothing from the storyline. So you've got to be able to make sure when you look for these as storylines, you start to see whether there's something in it for you. Now, this is why I handicap horses. This is why I use the underlying storyline that we use in the banking world to do exactly the same in the world of horse racing. I look to handicap the horses, and I look to try and figure out whether the handicap on the horse is good or bad or indifferent or whatever. And I come up with some selections. And I try and figure out whether that selection is going to be a bet or not. And I take a bet. If it has that storyline attached to it, I take the bet. I take the shout. I mean, if you were to look at my bets yesterday, you would be gobsmacked. And I was pretty gobsmacked at some of them as well. We've showed you this chart before. We've showed you this storyline before. And I want to just show you these bets because they don't show up very often. But obviously, we talk about the idea of having some sort of tradable edge. And it's important, if we have a tradable edge, it's important that we look at that tradable edge and we say, okay, let's get the bet on the books. Let's try and make some money. Let's see if that edge works. And obviously, this is the key to success in all trading, is to have that tradable edge on the screens. So let's have a look at two particular bets that I had yesterday. And I don't have many of these as edge bets. Let's have a little look. And again, this is about the story, isn't it? It's about the story. It's about putting the storyline together with everything else. It's about putting the storyline in line with the other pieces to the jigsaw puzzle. It's about having a genuine tradable edge and being able to prove that you've got a genuine tradable edge. Because if you don't, what's the point? What's the point in taking the deal? What's the point in playing that storyline? You might as well wait for something a little bit better to show up, mightn't you? So when we think about trading the edge, when we think about trading the concepts, it's about edges. It's about identifying some sort of edge that you can take to the bank. And it's not about winning everything, is it? It's not about then seeing it and saying, oh, I've definitely got a winner here. It's about recognizing that it might not be a winner, but it might be an edge that's good enough to give you some cash. It's an edge that if you take it over time, that there's a fair chance that you're going to make money more often than not. So when we start thinking about the edges and I start looking for specific setups in my order flow, in my trade log, in my thought processes, it's about recognizing that there's enough in it. If the edge is already taken away, well, there's no trade, is there? There's no trade. So we pass on it and we move on to the next edge and we see whether there's an edge enough to take the deal and to make the money work for us. I'm just taking a couple of screenshots of this because I want to show you how it played out. Because this was, as I said, this was phenomenal. This will not be repeated today. As far as I'm concerned, I don't think it'll be repeated today, because if it does get repeated today, we'll make a lot more money again today. But let's just take a look at 4 trades that came up yesterday with a genuine edge. Now, this is obviously about the systematic approach to something as ridiculous as horse racing. Non-manufacturing regional business activity index comes in at 1.4 in July. That is up from the negative 16.6 in June. The firm level business activity index. So this is the edge. Take a look at these edges. The rule is this, very simple, guys. The very final column here has to be above 8.0. Now, that's the benchmark threshold, okay? It has to be above 8.0. And we have to have a positive number above 1.0, preferably above 1.0 in the second last column as well. So the edge here is this bet here. It's the only one that goes above 8.0. You see that 8.4? The horse is Dorado. You can see that the horse won at 16 to 1. This horse here was 9.7. You can see that no other horse goes above 8.0. This horse was Spanish Angel. The horse came second at 10 to 1. This horse here was 26. 26. Oh, yes. 26. This horse won at 5 to 1. And then the final horse that we had yesterday was this horse here. A horse called Very Excellent. This horse registered a score of 8.7 on the algorithm. 8.7 on the algorithm. There's a horse called Very Excellent. Very Excellent won at 20 to 1 odds. So we had a 16 to 1 winner, a 5 to 1 winner, a 20 to 1 winner, in a 10-to-1 second place. Now, you just have to calculate out the odds on that happening by chance. I mean, if you take the bookmaker's odds there, 20 times 5 is 100. 100 times 16 is 1,600 to 1. That's possible, 1,600 to 1. Put 10 quid in that, you've made £16,000. £16,000 for a £10 stake. £160,000 for a £100 stake on that. By recognizing that setup. So obviously it's a very, very nice winning treble. Very nice winning treble, which will probably not be repeated today. But sometimes it does. That's unusual. Let's not make any mistake about it. That's an unusual outcome. But it's still the same process, isn't it? We're not saying that these are winning horses. What we're saying is that these exhibit a specific profile that gives them a far better chance than the probability assumed in the pricing of them, which is very similar to what we do in the markets, isn't it? If I look at the marketplace and I see a bottom line price, I'm making an assumption, for example, as a commercial buyer, that what I'm seeing in that low price is more upside than downside. And I take a buy trade against that story. That's all I'm doing, is exactly the same as this. I'm not saying that it is a buy. I'm just saying that it has a better upside downside probability risk reward ratio. And therefore it's big enough as a benchmark to take the trade on. That's why we have thresholds. That's why this indicator has a threshold of 8.0. You might be saying, but there was another one here of 12. Yep, but you're missing what I said earlier. This column here needs to be above 1.0. This column was not above 1.0. That is not a selection. It's not a selection. And the reason why it needs to be above 1.0 is I want to know that the people that own that horse or that know that horse are betting that horse. And that only shows that there is some sort of positive impact on the pricing when the price goes above 1.0. If the price does not go above 1.0, then the owners, it might look on the face of it to be good value, but the owners and the trainers and the jockey doesn't think it is. And therefore, this is barely just above 1.0. And the reason for that is because the odds were already very low. So the backers look at it saying, I think it's good value, but it's only just good enough value. Do you see the difference? It's only just good enough value. So this might not be a 5-to-1 horse. It might be a 4-to-1 horse. This one was significant because obviously they backed this one very, very heavily, 2.4. And therefore, this is not a 10-to-1 horse. This is a 5-to-1 horse. It still managed second place. This one here was even better. Look at this, 3.1. They absolutely knew that this horse was massive. So this might be a 16-to-1 horse, but it should be a 4-to-1 horse. This should probably be a 4 or a 5-to-1 horse. So it doesn't mean it's got a winning chance. It means it's got a far better chance than 16-to-1. See what I'm saying? It's got an incredibly far better chance than 16-to-1. So there's still a horse that's got a better odds. There's still a horse that would have a better odds, even if it was only a 4-to-1 or a 5-to-1 horse. But it still suggests that at 16-to-1, I could easily make my money on the place. Just the same way as I could easily make my money on the place here as well, because of the odds available. Now, it couldn't overturn the favourite on this occasion. Absolutely fine. Absolutely fine. Because the favourite still had this impressive horse still had a little bit of positive and a little bit of positive. So the favourite was still bid into that as a storyline, and that's absolutely fine. But I still think my horse has a better potential outcome. I was wrong on that occasion. 10-to-1 was still overturned by the 9-to-4 favourite. But you mightn't think to yourself that has no relevance to you as a as a trader. It has amazing, incredible relevance. Every trade we take needs to have a reason to deal. You've got to have an ability to find a mispricing. Otherwise, these guys are too good, Theo. These guys are way too good at what they do. But they occasionally do misprice something. So when I saw this trade on the Phillies at plus 1.5, and I was getting an even money bet, there was a lot of bookies that never gave me plus 1.5. There was some bookies that actually had it minus 1. Minus 1. But there was one bookie that was giving me plus 1.5, and I thought, am I misreading this? And I sent a text, an email to Kim last night. I know Kim knows her American sports, and I says, Phillies plus 1.5, that can't be right. Took the bet, made my money. It doesn't mean the Phillies are going to win. What it means is that Phillies at plus 1.5 are mispriced. They're badly mispriced. And it gives me a better probability of making money. Took the bet, made my monies. And that's all you can ever do in the markets, is to recognize that you have some sort of tangible, measurable edge in some way, shape, or form, whether that's through order flow. I'm not talking about always being about value, Theo. It's not always about value. It's about positioning. It's about location. It's about order flow. It's about structure. And it's about value as well. It's about the book. It's about the volume delta, the tick delta. So when we start to tie those elements together, we start to recognize where we see some of these incredible edges, where we see some of these really, really nice tradable opportunities like this short oil trade. There's an order flow edge, there's a value edge, there's a story, macro storyline edge to be short oil above 79. There's a volatility storyline to be short above 79. You're stacking the columns in your favor, if you like, aren't you? And you're going through each column saying tick, 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 tick. And every column's worth a weighting, for example. And you come to a score. And at the end of that score, you say, well, the score's above my benchmark. I am taking the deal. You see the point I'm making? The score goes above the benchmark. You take the deal. And you say to yourself, that's the one I wanted. That's the deal I needed. That's the thing I'm looking for as a trade outcome. I mean, if you take a look at the tick boxes on that oil short, for example, there, take a look at this screen here. Go through the tick boxes. First of all, what color is this in the background? What is your background color here? Does everybody see what the background color is? It's red, it's bearish. Okay? So if it's red and it's bearish, what am I going to be really focused on? What am I going to be really focused on? Can I draw your attention to the ags? So if I asked you to draw a tick box, would you like to see some ag selling opportunities in a bearish market, yes or no? Would you like to see some ag selling in a bearish market? So if we look at the ags, there's ag selling there, isn't there? There's ag selling here. There's ag selling here. There's ag selling here. Okay, so we can see where all the ag selling is in a bearish market. Secondly, let's move along to the next tick box. If there's ag selling and the orange line is at a clear premium against the red line, do we now have a supply that we can sell into? Yes, we do. So when we get this ag selling coming in here and this ag selling coming in here, did we have the orange line selling into supply, yes or no? Is the orange line clearly, visibly making a break against the declining red line? No, right? So does that pass the tick box at that stage? Does the short sell pass the tick box into that high price? Not a chance, right? Well, no, it doesn't pass the tick box test because the red line is making higher highs. So there's no trade here. But take a look at the trade to the side of it. Take a look at this ag selling here. Is the orange line making a higher high against the declining red line? Is the orange line making a higher high against the declining red line into that ag selling? Can we pass that tick box and move on to the next one? Yes, we can. When we pass through that tick box, is the crack spread divergent into the same cell? Yes, it is. So we pass through that tick box and we add another point to the benchmark. Let's take a look at the Brent oil WTI spreads. Was the blue line divergently bearish against the red line here? Yes, it was. So we can go through that tick box. Were we in a red market, which we've already covered? Yes, we were. Was the oil on the volatility still CVOL bullish? CVOL bullish. And if it's CVOL bullish, what does that mean? It means bearish net positioning. Yes, it was. We already showed you that earlier on today. We already talked about that earlier, that the CVOL on the WTI has still been telling us to be short oil today, even after what we've seen. We've seen the CVOL on WTI still very definitely bullish. And we suggested that means that we should be working that short sell into top edges. If the CVOL is bullish, in other words, the change is green, and the short term is catching a bid against an uptick in prices, I want to sell that. And did we highlight that storyline? Did we highlight that storyline to everybody in the tweets last night? Yes, we did. And therefore, we now have all the tick boxes lined up for that short sell, didn't we? The tick boxes are now in place. The tick boxes are now lined up. We can now see if we can add the tick box in terms of order flow. But the order flow is not a yes or a no trade, is it? It's what kind of trade. Is it an aggressive sell or a passive sell? Is it the kind of sell we want to be aggressively leaning against, or do we want to passively fade into? We can see there was a heavy buy coming in, therefore it's going to be a lean trade. So we don't use sell limits. We don't sell 79 or 79.5s or 79.10s. We lean into that buying. Or not into the buying, we lean against the buying, but one tick below, right? So it's a lean trade sell. Does everybody agree with that? It's a lean trade sell if we're using that particular trade there. Now, the trade we're actually talking about is this one here, because that was the top edge trade. So what kind of trade did we have here? It's still the same. You're still getting buying against net selling. So you're leaning against that trade, aren't you? You're leaning into that trade again there, aren't you? And you're getting another short sell. The structure is bearish. The sell is given. And therefore, it's an easy short sell to get that deal done. Easy short sell to get the deal done. And obviously, selling off of the top edges or selling off the pullbacks or selling off anything else, it's just simple, guys. It doesn't matter whether it's a pullback in this area here or a pullback in this area here, or going all the way back to the sell at the top edges here at the cash market open. It doesn't make any difference which one we deal. It's the same tick box structure. It's the same process. And sometimes, like the horses yesterday, sometimes it knocks it out of the park. As I said, yesterday was an exception to make a 1,600 to 1 winning treble. 1,600 to 1 winning treble made us a lot more money. I made a lot more money in horses than I made trading yesterday. And that's with a couple of very big trades that we had yesterday. But that was one of those 1,600 to 1 trebles that don't happen very often. It happened yesterday. It happened yesterday. But when you get them, Life becomes incredibly valuable to you. You look at those value trades and you look at those areas and you think to yourself, my goodness, that is how we should be dealing. Well, that's exactly what we teach here. You build however many boxes you wish to build up your pointing system, to build up your benchmark, So in other words, when you were looking at the horses and we had all these columns on a spreadsheet, think about your WTI trade as the same thing. So in this line here, you've got your WTI, and then it has a box that says RGL. So you've got a box that says RGL, and then you've got a box that says RGL. You've then got a box that says supply. You've then got a box that says structure in terms of the underlying structure. You've then got a box that says Brent. You've then got a box that says dollar. You've then got a box that says crack. You've then got a box that says order flow. And each of these boxes in general structure, you can say, I'm going to give this a weight. I'm going to give this a weight of, say, 1.0. I'm going to give this a weight of 2.0. I'm going to give this a weight of 0.5. I'm going to give this a weight of 0.7, and so on and so on. And you can recognize the idea. Tick the box and get the points. Tick the box and get the points. And these are just made up numbers, guys, just so that you get the basic idea. But order flow doesn't have a weighting because obviously that order flow is not a buy or a sell signal. It's a type of buy or sell. So we get the idea. So all of a sudden, this box here gets a tick and you get the 1.0. This box here gets the tick and you get 2.0. This box here gets the tick and you get 0.5. This box gives you 0.7. This box gives you 0.5, and this box gives you 0.7 again. So all of a sudden you can say, right, my threshold is I need to get above 2.0. Well, you're already above 2.0 with the RGL in the supply line in the first place, aren't you? So your benchmark at 2.0 is quite easy to achieve. And it would be very difficult to achieve 2.0 unless you got one of these two in favor, because obviously the four of these together only makes 2.4. So if you lose any one of these elements, you would never achieve your 2.0 threshold, would you? So your benchmark at this stage might be 2.0, and that therefore it gives you an idea that you can't take it if it's only got supply in line, because it's only 2.0. So your benchmark would actually be 2.1, for example, right? So you can't just sell it if it's just got the RGL. You can't just sell it if it's just got the RGL, the break of structure, and the dollar. You've got to have one other supply-demand element in your favor to take the short sell. So when we think about that, we start looking through this and we say to ourselves that, well, that's exactly what this oil had. It had the RGL. It had the background structure to the storyline. We had the $79 level. We had the C-vol, which we haven't given a weighting to. We have this Brent oil spread. We have this crack spread. We have the volume surge on the ags, which we haven't also added at this stage. So obviously you can see you could add each of these areas to build your own benchmark, because that's what being the PhD student gives you. The PhD student gives you the ability to put your threshold as high as you wish to capture the big trade opportunities. So obviously when we talk about today's London session S&P, we'll be looking at that as an idea, as a process, again, into the undergraduate trade, and then looking to see whether the postgrads actually agreed with the undergraduate trades today. But before that, I'm going to go and go through the numbers today so far. And there's not been that much, which is why we're babbling on at the moment. There's not an awful lot of data today to be truthful about anything. But anyway, Japanese core inflation came in at 3.0. No real surprises. It was in line with the forecast at 3.0. It's not something that generally goes out of line. The German IFO, again, disappointed. Not surprising following yesterday's German manufacturing and services PMIs both missing. I don't suppose it was a surprise to anybody to see the German IFO business climate coming in disappointing at 87.3 against the forecast of 88. So no surprises there from the German IFO surveys. And obviously we're now moving into the second phase of the afternoon session, the 2 o'clock data releases. We've got house prices coming up in the US, 0.6 forecast, and the composite 20-year minus 2.3. And then we've got consumer confidence numbers at 3 o'clock, the most important numbers of the day. Expecting to see an uptick in consumer confidence in America, 112.1 from 109.7. And then Richmond manufacturing at the same time slot, -9 against -7 prior. Oil still selling, 79 just traded, 78.40s, guys, for an additional $600 profit on that short sell-sided business that we shouted this morning several times. 79 bid is not a trade I want to be on unless I'm selling it. Perfection. Absolute trade perfection. That's what that is, guys. So hopefully something in there makes sense to you. We'll obviously cover the undergrad trades when we come back after 2 o'clock, just before today's cash open, so you can start considering it into today's US cash open. We'll take a little 10-minute segment before today's cash open to get through today's structural undergrad trades from the S&P at the cash open of the London session. I'm going to grab some lunch. I'll be back in 5 or 10 minutes.